Retired Employees Healthcare Benefits Trust, Wednesday, April 26, 2023, 7:30 a.m. Attendance, looks like all members are in attendance. Open the floor for public comment, if any. Looks like no public comments. We'll move on to close that and approve, look for a motion to approve meeting minutes of January 31st, 2023.
So moved. Support.
Moved by Trustee Shostak, support by Treasurer Keeps. So we'll move on, turning it over for a first quarter 2023 financial review with Brian Green from ANCO.
All right. So if I can sum up the first quarter of 2023 in a few sentences, it would be in relation to calendar year 22 is for Q1, what was first is last and what was last is first. Complete reversal. Your only disappointment, I'd say, from an investor standpoint would have been not being more fully invested. You kind of had this thought of going through calendar year 22. Everyone was celebrating cash by the end of it because cash yields were north of 5% on money market funds, not so much on traditional checking and savings accounts at the banks or the credit unions. Those are still paying something just north of zero. But from a traditional money market standpoint or treasuries, anything from a short-term cash management, it's an infinitely more attractive environment. But as we saw the Fed pause on the degree of rate hikes, right? We did 50 rather than 75. Some concerns over maybe things are cooling a bit from an inflationary standpoint. Things are cooling a bit from an economic growth standpoint. As we saw rates actually decline in the quarter, growth stocks rallied, and they rallied significantly. To give you an example, the S&P 500 was up 7.5% for the first quarter. The Russell 1000 growth, which would be large cap growth dominated really by tech and consumer discretionary, was up 14.4, and large cap value was up 1.01. So there was a 13.5% difference in performance between large cap value and large cap growth. Now, you think about it a bit from a headline standpoint and kind of think back to Q1. January and February are kind of benign. I will tell you, for a 2-week period in the month of March after Silicon and Signature failed, having the same kind of feeling of stress and anxiety that we had in September and October of 08 when we saw Lehman and the likes start to fail. Thankfully, little to no exposure. In the S&P 500 index, for example, Signature was in there, but I think it was a 0.04% position. And the reason, you look at large cap value and say, well, I would expect value to underperform in an environment like that, given that it's got a higher degree of financials. Well, the largest names in the banking part of that are B of A, JP Morgan, Citi. Those names are all in positive territory for the quarter. It was the regionals like Comerica, as an example, that were down 30 or 40% for the quarter, just based on continued concerns and some headlines out of Moody's over a potential downgrade. And now we've actually seen a downgrade in terms of their ratings. International markets in positive territory as the U.S. dollar weakened a bit. International developed stocks were up 8.5%, and emerging market was up 4%. I would say the big surprise, and this is where we saw the reversal in terms of performance, we were coming in last year and celebrating in fixed income only being down 9 or 10% because broader indices were down more than 15 as we saw that significant increase in interest rates. The U.S. aggregate, which would be a proxy for high-quality U.S. investment-grade fixed income maturing in kind of the next 7-ish years, was actually up 2.96% for the quarter. And 2.5 of that, we'll just talk in round numbers, 2.5 of that 3% figure came in the month of March. So for January and February, fixed income was essentially flat, maybe up 0.5%, but with the decline in rates that we saw, the 10-year was north of 4% early in the quarter, finished the quarter just shy of 3.5. So just that significant decline in interest rates and that rally in bonds definitely drove the recovery. So in that same view of what was first is last and what was last was first, if we look at calendar year 22 from a sector standpoint, the S&P was down 18% last year. Only 2 sectors were in positive territory. Utilities were up 1.5%. Energy was up 65%. But the three worst performing sectors last year were information technology, consumer discretionary, and communication services. Those are the three largest parts of the growth side of the style box. The three best performing sectors so far here in 23, information technology, communication services, consumer discretionary. What's changed? Just the interest rate environment. So I'd argue that that's probably kind of a short-term blip. But nevertheless, that's actually been a big tailwind in terms of recovery we've seen, for example, out of Edgewood's portfolio. So we'll go a little bit deeper into the book. Michael, I think you'd asked about this one at the last meeting, just looking at overall market values for the various retiree healthcare trusts. So this just looks back on a rolling one-year basis, and you can see the growth of the assets as well as the growth of the individual trusts. You know, it is worth noting, if you look from March of 21 to March of 22, that was when public safety was separated out of VEBA so that it would be tracked and accounted for separately. So that's the reason for that decline in market value from 21 to 22 for the VEBA fund, but just shows the breakout. Obviously, the public safety is the largest component of it, and the cable fund would be the smallest. So each are maintained in separate accounts. Each are invested in their own respective investments, but obviously the manager lineup is identical, and the asset allocation targets for each are identical. There will be some differences in performance from time to time, just based on cash flow coming in and just the timing of that money being invested. But if we look, for example, going to page 3, talking about overall for the quarter, the combined retiree healthcare trust was up 5.1, call it 5.2%. Ahead of the policy index, that was up 4.8. March 31st may seem like 3 months in from a personal standpoint, but that's the end of the fiscal year for the township. So on a fiscal year-to-date basis, in negative territory. The rally we saw in the fourth quarter last year, the rally we've seen so far this year, just wasn't enough to offset what happened in the second quarter and third quarter of 22. So for the fiscal year, putting a wrap on that, down 4.85, ahead of the policy index, but victory laps for losing less money are pretty empty. So what helped and what hurt? Ancora underperformed for the quarter and underperformed in the last year. Majority of that underperformance was actually driven by stock selection in healthcare, names like J&J, United Healthcare, and some housing-related names like Home Depot, as we've seen a slowdown there. Fidelity S&P 500, no surprises. I will tell you that the 7.5% rally, I think 90% of that came from 6 names. Names like Apple and Microsoft, not a surprise, but some other big rallies. Nvidia was up 90%. Meta or Facebook was up 76% in the first quarter. So just amazing to see that kind of big swing. Edgewood, which had been a laggard last year, remember that stock is always 22, or that portfolio is always 22 names. Never 21, never 23. So if they find a new idea, it's got to be better than their 22nd best idea. Strong rally in the quarter as growth stocks rallied. Slight outperformance for them, actually due to being overweight Nvidia. With that stock up 90%, it's become a 7% position. Remember the comment early, the moral of the kind of the story of the first quarter was what was first is last and what was last is first. So Clarkston, phenomenal job, outperformance last year in a difficult market environment, was flat for the first quarter versus their benchmark that was up 3.4. Some common names here helped last year, have hurt so far this year, notably Stericycle and AMG, Affiliated Managers Group. Another name that continues to be a drag is Altice. Fidelity Extended Market Index Fund. Remember, this is the entire U.S. equity market. Kick out the 500 names that are in the S&P 500 and own everything else. So it's thought of as a small mid-cap benchmark, but there are going to be some larger names in there. Until Tesla's a shining example. Until Tesla was brought into the S&P 500 in terms of a consistency of earnings standpoint, it was in this index fund. Performance driven by some of the biggest names, interestingly hurt last year but have helped this year. Blackstone, Uber, Airbnb. The one surprise I would say, so growth has rallied. The Oakmark International portfolio has always had a bit of a value bias to it. And it goes through fits and starts where it's a fantastic performer. It's top 10 in the universe, then it's bottom 10 in the universe. Then it's top 10 in the universe just because of their more concentrated nature. They were up 14% in the first quarter, and I'll tell you that was out of the realm of expectations. Coming into the quarter, knowing that growth outperformed and value underperformed, our expectation was that they actually would have underperformed. But it's a number of names like Continental AG, BMW, Mercedes, and Adidas that all helped. They were also early out of Credit Suisse before everything unraveled for them and they merged with UBS. But great outperformance for the quarter. And on a fiscal year basis, they're actually the number one performer. They're the only equity manager that's in positive territory. Fidelity International Index, no surprise, right in line or slightly ahead. That's always going to be close. International, replicating that international index fund isn't as simple as replicating the S&P 500 because there's names that you flat out can't own because you would either own a controlling interest of the company or could, in theory, own all of the tradable shares. So there's limitations on what can be done with that portfolio. JP Morgan, from an emerging market standpoint, strong outperformance for the quarter and for the fiscal year. Again, continues to be that story of a growth recovery because that portfolio has always had a growth bias, which we think is appropriate in emerging markets. Taiwan Semiconductor was the largest name, and Mercado Libre, which is kind of the Amazon of South America, were two of the biggest drivers of performance for them. And then finally, rounding it out from a fixed income standpoint, positive news out of Baird for the quarter as well as Brandywine for the quarter, both hanging in on a fiscal year-to-date basis, those negative returns obviously being driven by the sharp rise in interest rates that we saw in calendar year 22. So all in all, the portfolio continues to be in good shape. Continue to look for opportunities, but as it sits right now from a manager roster standpoint and from an asset allocation standpoint, we're comfortable with where things are positioned. That's the extent of prepared comments. Happy to answer any other questions.
Any questions for Brian?
So you said that each of the sub-accounts have the same allocation?
Right. Same targets, but this is where, there could be a 0.1 or 0.2% difference in position, like with Edgewood, just based on timing of cash flow coming in and putting that money to work. And you'll see swings in performance when if it were up 3% for the quarter, everything would align. But when you've got something that's up 15% for the quarter, that 0.1 or 0.2% difference makes a difference in how total fund looks. But they're all very, very close to each other.
Anything else for Brian?
Nope.
Thank you, Brian. Next item, we would staying on the same schedule between this committee and the Financial Sustainability Committee. The next meeting would be July 26, 2023 at 7:30 a.m. Is there any conflicts known at this point? Okay. Any new business from any committee members? I just wanted to add that this last quarter we did make the contributions into this trust. So we had $500,000 from the general fund, $750,000 coming from public safety, and $250,000 for the water and sewer fund.
Can you
Those
repeat
are
that, please?
500 general fund, 750 public safety, and 250 from water. And those are done on an annual basis based on the budget.
So is that reflected in the numbers here for each fund?
It should be, because that was in, I believe, February. If there's nothing else, I'll look for a motion to adjourn.
So moved.
Support.
Moved by Brian, trustee Keeps, and trustee Shostak, thank you. Adjourned.